Okay, so Canvas, right? It's huge. Like, it runs 41% of higher education in North America. And the CEO, he said contained on May 2nd. But the market, it priced him 68% wrong. Just wrong.
Yeah, and here we are just days away from shiny hunters dropping 275 million student records unless a ransom gets paid. I mean, Penn, Princeton, Columbia, Harvard, even Wake County schools, all on Canvas, all locked out of finals this week, all staring at that same deadline. It's wild.
And here's the kicker, Marcus. Item 1.05, the SEC's 4-day cyber disclosure rule, it doesn't even apply. KKR took Instructure private for $4.8 billion in 2024. The tripwire? It didn't fail. It was legally, just removed. Poof.
Most coverage, honestly, is reading this as a cybersecurity story, you know?
Oh, it's not. It's a disclosure architecture story. The 13-point gap between cyber ed, which is at 0.68, and the implied 0.55, that's the volume of truth that used to be public, and it's just gone.
So by Wednesday night, May 14th, we'll know whether the US even has a public disclosure regime anymore for these platforms holding our kids' transcripts. If cyber ed is above 0.65 with confirmed exposure, the market caught what the SEC can't. Below 0.50, containment's validated, and the structural problem just stays buried. It all turns on this one 2024 transaction nobody really read closely.
Yeah, let's start there. I mean, what is Canvas really? I know it's not just like an app, right?
No, it's not just an app. It's the digital plumbing, Marcus, for 41% of North American higher education. We're talking 30 million active users, an estimated 275 million historical records. Names, emails, student IDs, course enrollments, instructor communications. North Carolina actually adopted Canvas across every K-12 school back in 2015. So it's not just a vendor relationship, It's the literal infrastructure of public education.
Wow, that's huge. And then that infrastructure was bought?
Exactly. In November 2024, KKR and Dragoneer Investment Group bought it for $4.8 billion, all cash. They took it private. Steve Daly stayed as CEO, which is interesting. But that's the core structural fact the prediction market is really pricing in right now.
Okay, so what changes when a company goes private? I mean, I know there's a big difference, but specifically for this kind of thing.
Well, public companies have Item 1.05 of Form 8K. The SEC adopted it in 2023, right? It's this mandatory disclosure of material cybersecurity incidents within 4 business days. That rule was designed to be a federal tripwire. Get hit with ransomware on Monday, by Friday the SEC and the public know. It doesn't prevent breaches, but it surfaces them. It's supposed to. So here's the analogy I really want to put out there, Public companies operate with a black box flight recorder. It's federally mandated. When something goes wrong, or even when nothing goes wrong, but you need to check, there's a record an investigator can pull. Take the company private, though, and that recorder, it's legally removed. The plane still flies. The crashes still happen. There's just no recording for anyone to recover. That's exactly what KKR did to Instructure in 2024. The plane's in the air, but the recorder's gone.
And the rule isn't being violated. That's the thing. Daly can stand at a podium and say contained on May 2nd and not break a single regulation because the regulation simply doesn't apply to him anymore. That's the part I think most coverage is totally missing.
Absolutely. Which brings me to the framing I want to push on. The standard analysis treats this as a loophole, like an unintended gap in the disclosure regime. But I don't think it's a loophole. A loophole implies someone forgot to close a door. This door was actually opened by the architecture itself. The SEC wrote a rule for public companies. Private equity bought a public company and took it private. Nothing was forgotten. The architecture worked exactly as it was structured. What it didn't anticipate was critical infrastructure moving from public to private ownership, specifically to escape that disclosure cadence,
That's a real distinction. A loophole gets closed. A structural feature, it doesn't.
And this is where that 13-point gap becomes totally legible. Cyber ed is at 0.68. The narrative implied price is 0.55. Those 13 points aren't noise, Marcus. It's the volume of disclosure the public used to receive that's now just privatized. Capital is doing in a contract market what the SEC used to do in a filing system. Both are surveillance instruments, but one is legally compelled and publicly accessible. The other is voluntary, expensive, and only accessible to participants who can afford to trade it.
So what we're looking at then, by the end of this, chapter, is not a breach story.
It's a story about which surveillance instrument now functions for which class of participants. The federal one no longer covers Instructure. The capital market one does, but only like for traders.
And that 13-point gap? That's the price of that asymmetry. The 275 million users whose data is on the line, they don't have access to the surveillance that's actually working. They only have access to the surveillance that's been structurally removed. This is where I really want to push on what the data is implying but not saying. The standard analysis treats Canvas as the case. I think Canvas is the demonstration. Once a private equity firm has run this play successfully, once KKR has shown you can buy critical infrastructure, take it private, and remove the disclosure overhead while keeping operational control, that play becomes a template, you know? And it's totally replicable.
Replicable how? Walk through the mechanism.
Okay, so public equity infrastructure platforms, healthcare records vendors, financial transaction processors, voter registration systems, education platforms, they all face escalating disclosure costs as breach frequency rises. The SEC's 4-day rule sounds simple, but in practice it requires legal review, materiality assessment, ongoing investor relations management, litigation exposure, share price volatility on every disclosure. That's overhead, and that overhead just doesn't exist for private companies.
So the differential cost of breach disclosure favors private ownership at the margin then?
At the margin, Marcus, and accelerating. Later in What the IMF Said Yesterday, Kristalina Georgieva published a paper on May 7th naming Anthropic's Claude Mythos preview specifically, a model the IMF says can find and exploit vulnerabilities in major operating systems and browsers, even when used by non-experts. Andrew Bailey at the Bank of England said Frontier AI could crack the whole cyber risk world open. That's a financial stability framing, not a security framing. They're basically saying breach frequency is going up structurally.
So if breach frequency rises, the disclosure overhead for public companies rises differentially. The cost gap between public and private ownership widens, and take privates, they just accelerate.
And here's the lateral connection I want to put on the table. This isn't just an education story or a cybersecurity story, Marcus. It's a regime story. 5 to 10 years out, what does this become? Critical infrastructure migrates en masse from public visibility to private opacity. Not because anyone decides to make it less transparent, but because the optimization function simply rewards that migration. Healthcare records, payment rails, identity verification systems, school infrastructure, anything currently public equity owned where breach disclosure overhead is a competitive disadvantage becomes a take-private target.
And the prediction markets then become the de facto disclosure regime for this privatized layer, right?
That's the mechanism. Capital markets become the surveillance instrument the SEC used to be. The 8K filing system loses coverage as its target just, migrates out from under it. The Cyber Ed contract is functioning today the way an 8K filing functioned in 2023. By 2030, the contract architecture is the disclosure architecture for any infrastructure whose ownership has migrated. But here's the question I can't shake. If prediction markets become the de facto disclosure regime, who runs them?
What do you mean by who runs them?
A contract on a platform like Kalshi only exists because someone designed and listed the question. Cyber Ed resolves on whether a major US education platform reports a breach by June 1st. Someone wrote that resolution criteria. Someone decided report means a public statement, not an internal acknowledgement. Someone decided which platforms count as major. Every one of those decisions is a gate. The contract designer is now in the position the SEC used to be in, defining what counts as a disclosable event. But the contract designer isn't a regulator. They're a market operator. Their incentive is liquidity, not transparency.
So the disclosure regime is migrating from regulator to market operator.
And market operators only list contracts where there's enough trading interest to generate fees, right? Events where the price would be obvious or where no one cares enough to trade, they never get listed, which means events that don't get listed don't get priced. Events that don't get priced don't get surfaced.
That's the new asymmetry. The federal disclosure regime surfaced everything material by mandate. The market disclosure regime surfaces only what generates trading interest by selection.
The privatized surveillance instrument has gatekeepers. They just aren't accountable to anyone the way regulators are. Not at all. Now, I want to push on that actionable frame you opened with. You said by Wednesday night, listeners would know whether the US still has a public disclosure regime for these platforms. Cyber Ed above 0.65, PII confirmation by May 14th. That's a That's the watchable signal, right?
That's the signal, yeah.
Here's where the frame breaks, though. The signal assumes the contract is pricing the truth. CyberEd resolves on whether a major U.S. education platform reports a breach by June 1st. The contract isn't measuring whether harm occurred. It's measuring whether someone discloses. If the disclosure architecture is being removed, if the system is migrating to a regime where reporting is increasingly optional, then that 0.68 isn't 68% likelihood of a real breach. It's 68% likelihood of a reported breach in a system where reporting itself is becoming voluntary. Do you know what I mean?
That's a real challenge. Let me hold the strongest version of the position you're pushing on. The contract isn't tracking SEC compliance. That's already been removed. The contract is tracking the eventual surfacing through every other channel, though. State Attorney General data breach notification statutes, FERPA exposure forcing federal investigation through institutional clients, state AGs in California, Pennsylvania, North Carolina, they'll all activate, right? Penn alone has 306,000 affiliate records exposed. So the market isn't pricing whether the SEC will surface this. It's pricing whether any of the redundant disclosure pipes will surface it. And those pipes are still operational.
They're operational, yes, but they're fragmented. California's notification window is different from Pennsylvania's. North Carolina's statute is different from both. The market is pricing an aggregate eventual surfacing across uncoordinated jurisdictions over months or years. That's a real signal, but it's not the signal a 4-day SEC tripwire was. The federal coherence is gone. What replaces it is just noise.
That's where the frame I opened with has to take its hit. I said the listener would know by Wednesday whether the disclosure regime still functions. The honest answer after this conversation is that the regime hasn't been replaced cleanly. What exists now is a fragmented combination. State AGs at different cadences, FERPA running through institutional clients, prediction market pricing aggregating in the background. Capital can read the noise, but 275 million users whose data is exposed will learn in pieces through different channels over months. The signal is real. It's just slower and noisier than what the SEC's rule provided.
And that revision changes who the disclosure regime actually serves. The 4-day SEC rule served everyone equally: public access, mandatory cadence, single source of truth. The fragmented regime serves participants asymmetrically. Capital allocators with access to the contract market read the aggregate. State AG notifications reach exposed users individually, eventually. FERPA actions run on multi-year timelines, totally invisible to the people whose records were taken. The pattern from the open resolves like this. The SEC tripwire was structurally removed, and what replaced it is not one new tripwire. It's 3 different tripwires running on 3 different clocks for 3 different audiences.
And that's the answer to what's binding daily. Nothing is, not in the way the SEC used to bind a public company CEO. What's binding him is a slower, noisier, asymmetric pipe that won't surface anything actionable until long after the exposed data has already moved. So, here's what listeners can do with this by Wednesday. Watch CyberEd through May 12th. Watch for PII confirmation at any major institution by May 14th. That's still the operational tripwire, but the deeper move is the one we landed on. Anytime you're considering using or trusting a critical infrastructure platform, your kid's school, your healthcare provider, your bank, the question to ask is not, is this secure? Security postures vary. The question is, who owns this and what disclosure obligations actually bind them? If the answer is private equity, the SEC tripwire is gone. What you have left is fragmented state notifications running on 3 different clocks. Plan accordingly.
When WA becomes variable, Marcus, the only constraint left is conscience or fiscal interruption. KKR isn't exercising conscience. The federal fiscal tripwire was just removed. So what's binding them? Nothing. The market priced nothing at 0.68 before any human even said it out loud.
We'll find out by Wednesday whether that price was conservative.
Well, thank you, our incredible viewers, for joining us for what has been a truly critical, even unsettling analysis. That looming Wednesday deadline underscores a massive shift in how we understand transparency.
Indeed, Marcus. The market's pricing and the events of this week tell a story about a disclosure regime fundamentally changed, leaving many without a clear path to the truth.
And that's why understanding this new landscape is vital for everyone. Knowing who owns your data and who is truly accountable has never been more important, especially with these new gatekeepers.
Exactly. The fragmented truth we've outlined demands new vigilance. Old tripwires are gone. replaced by a complex, multi-layered system requiring constant active interpretation.
Before we sign off, a huge thank you. Your engagement drives these conversations. If valuable, please help us grow. Like, comment, share, and subscribe to our channel. Your support makes a difference.